everybody, Nate here, and the Federal Reserve just made a huge announcement on its monetary policy and, more importantly, its interest rates for 2023, and it kind of went something like this. Hello Americans, we hope you like 2022 because 2023 is gonna be a little rough. And to be honest with you, we don't really care. Alright, they didn't say exactly that, but Federal Reserve Chairman Jerome Powell just came out in a press conference today and said the Fed is going to have to make some very unpopular opinions in 2023 in order to bring down inflation and get our economy back on track. He said, quote, "Price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy." He then added, quote, "The absence of direct political control over our decisions allows us to take these necessary measures without considering short-term political factors." And other members of the Federal Reserve believe, as Federal Reserve Governor Bowman believes the exact same thing. The Fed needs to do a whole lot more if they want to bring down inflation this year and then keep it low. So let's go ahead and break down what the Federal Reserve is talking about now, what all of this is going to affect in 2023, and how you can be the most prepared for anything it decides. So when the Federal Reserve talks about making unpopular opinions, we have to address who the popularity is, and that's going to be the American consumer and the stock market. Federal Reserve's monetary policies over the last couple of years have directly impacted those two parties, the consumers and investors on Wall Street. The Fed basically has control over the supply and demand of money in our economy, and over the last couple of years, they have sparked demand with really low interest rates and tons of money printing. Now they're kind of on the back end though and reversing a lot of those policies in order to bring inflation down and lower demand in our economy. Now, if the Federal Reserve continues to raise its interest rates very quickly and aggressively, that is going to be very unpopular with Wall Street because it directly impacts Wall Street's ability to borrow money, and it affects the businesses that have already borrowed money, their ability to actually pay back the money. So investors are not going to be able to invest as much money because they can't borrow as much money. They're not going to take all of their own funds and invest in companies because if they lose, then they don't have any more money to invest in the future. So the vast majority of investors, your big investors, are going to be borrowing a lot of their capital, and they're going to use this money to then invest in businesses, and they can do this a lot easier when interest rates are low. That's why we saw a ton of investment in 2021 and 2022 because investors had a lot of money to spend, but those days are pretty much over for the time being because interest rates have been going up. Interest rates over the last couple of years were 0%, but starting in March of 2022, the Federal Reserve began raising their interest rates. This was one of the worst periods for inflation our country has seen in about 30 or 40 years. Inflation is bad news for everybody. It's a systemic issue that doesn't go away until you have that demand go down in your economy. It basically means that the value of everyone's dollars is becoming worthless, and you need a whole lot more money in order to buy all of the same things. Your buying power also is going down in periods of high inflation. That's bad for the Federal Reserve, and it's bad on a global stage for countries that want to borrow and use our money. We need our currency to be very strong, so the Federal Reserve has a duty to the United States federal government to keep inflation low at their target level of around 2%. What's interesting though is the Federal Reserve is not technically a government entity. They get a ton of influence from the federal government, but they are technically their own independent agency, so they can make decisions like raising and lowering interest rates on their own, and they don't have to rely on a bill or the president to make that decision for them. That means the only thing that they're influenced by is United States dollars and the power of the dollar on the global stage, and lately that has been getting a lot lower as countries have been selling off United States debt. So that is the Wall Street side, and you got to remember investors on Wall Street and the stock market, well, they're all about growth and they're all about making money, and they want to do that as fast as possible. They want to put as little as possible in and get the most out. That is how the stock market works. So now they're kind of pushed to the edge and they have to invest more, and of course they don't like to see that because it means lower profits and it's harder to invest in general. Things are still going to grow. You're still going to have businesses grow. Not everything is going to crash in your economy, but slow growth is not good enough for the stock market, especially from what we've seen over the last couple of years of this explosive growth. They want to get back to that. So the higher those interest rates go, the harder it's going to be to achieve that from the investor side. If we look at the consumer side, well, Americans are already having a really hard time with inflation right now, and and the price of everything. Food prices, energy prices, gasoline prices, and more have all gone up over the last 2 years. And that means that Americans are having a hard time buying all of the same things, and wages have not really gone up enough in order to meet all of those new price changes. Not only that, but it's really difficult to buy a home right now because interest rates have gone up for a 30-year fixed mortgage in the 6th and 7th percentile. That means that millions of people are simply just barred from getting a mortgage. They can't afford one because they're priced out because the interest rate is way too high. Those monthly payments are going to be too high for the average American. Same with auto loans and same with spending on credit cards. Everything that deals with the Federal Reserve and borrowing and banks right now is going up, which means it's harder for the average American to get by, and that is really tough. The whole goal here, though, with the Federal Reserve's plans is to reinstitute price stability, so that way you don't have wages and you don't have prices going up all the time. Everything is kind of stable, so that way if Americans are making a certain amount, they can relatively expect to go to the grocery store and have prices be roughly the same every time, not $5 to $10 more expensive every single time. That price stability comes from Federal Reserve interest rates because they control kind of the flow of money in our economy with raising demand and lowering it. That means you're going to have periods of high inflation and periods of low inflation. The big problem right now, though, amongst investors and experts is that the Federal Reserve might end up doing too much. There is a consensus right now that inflation is starting to go down in our economy, like the Consumer Price Index or the CPI report that basically measures prices on a month-over-month level has been decreasing. So we know that generally in our economy, prices are starting to come down, and that is good for consumers and it's good for businesses because now consumers can go out and buy more. So investors are really wondering why the Federal Reserve would want to continue to be aggressive with its interest rate policies considering inflation has started to come down. This is the big question that will eventually be answered probably sometime this year. Is the Federal Reserve doing too much or are they not doing enough? To answer this question, you kind of have to look back a little bit. Now, we've had this inflation problem in our economy since about the middle parts of 2020. The Federal Reserve, in response to the pandemic, started its quantitative easing program for Wall Street. So it was going to start purchasing corporate bonds and treasury bonds. And that meant that spending for corporations and for our government exploded. I mean, think of all of the big bills that were passed during that time. Not only that, but we had stimulus checks and we had unemployment programs, and there was just so much money flooded around our economy. In fact, at the beginning of 2020, we had around $3 trillion in circulation, and today we have over 20 trillion. So there was a lot of money, and there is still a lot of money out there. So that is one cause of inflation. And then we also had supply chain issue problems because of economic lockdowns. People weren't working, and when they finally did get back to work, everything was behind, and we're just now starting to catch up to those supply chain problems. And then finally, geopolitical conflicts like wars and countrywide bans and all of these other problems are also making certain things go up in price too, which means more supply chain problems and it means more inflation. So there was a lot going on, and to top all of that off, we had the Federal Reserve lowering its benchmark interest rates to 0%. That meant a ton of business investment. That meant that people were going out and getting mortgages and buying cars and all of this economic expansion, which just meant a whole lot more money. And all of that wasn't really a big problem at first, but then we had this inflation problem. Prices started to go up because of the sheer amount of demand that we had. We just didn't have enough products in order to support our entire infrastructure, at least for a little while. So prices started to go up, inflation started to go up, but this went on for several months before the Federal Reserve started to even talk about raising its interest rates. And then finally in March of 2022, they raised their interest rates. Many experts, though, believe that the Federal Reserve is far behind the curve. So where interest rates are supposed to be is still behind where they need to be in order to tackle inflation. That means the Fed might need to raise its interest rates to 6% or higher in order to bring things down. But knowing that they're behind, the Federal Reserve may end up doing too much that restricts our economy way too quickly. People are already having a hard time with inflation. They're already having a hard time buying things, and businesses are laying off people like crazy. So with that being said, if the Federal Reserve continues to go further and further, then that might hurt our economy and send it into a recession. A recession means even more job loss, but in the Fed's eyes, this means even less spending, which will hopefully bring down demand and thus inflation. So this is all very calculated from the Federal Reserve, and they walk a fine line here, and they have to keep their expectations high, and they have to let you know that they're working on inflation, because the second they lift their foot off the gas, the stock market is going to explode and consumers are going to start borrowing. So they have to say that we're going to be very hard on inflation, we're going to do everything we can to bring it down, and we're going to make some unpopular opinions in order to do that. So that way they keep everybody's expectations in check, and people aren't fearing, because they're not saying we're in a recession and everything's going down really quickly, but they're not also super happy. So this is kind of the equilibrium that the Federal Reserve creates. And finally, you have to consider, well, is the interest rate hikes going to actually bring down inflation? And eventually it absolutely will. And the federal government is counting on this and is basically making the Fed solely responsible for bringing down inflation. But there are other ways to lower inflation in your economy. You don't just need really high interest rates. Really high interest rates just bring down demand, right? They just make it harder for everybody to do things, and the harder you make it, the fewer people are going to do things. So if interest rates from the Fed went up to 10%, nobody would invest, nobody would spend money, and if nobody's spending money, that gives supply time to go back up and reach where demand is. Then the Fed can lower interest rates again, so people are incentivized to go out and spend money. That is pretty much their only monetary tool. They can lower the demand or they can raise the demand, but Congress also has a lot of power in their own right to pass bills to make our entire economy a whole lot more efficient. We could have more executive orders from the president. There are a lot of other things that affect inflation, and you gotta think the reason that we have inflation is because prices are high. The fact of the matter is, all of that money that the Federal Reserve printed is already out there. There's not really much that they can do to draw it back in right now. So that money has to be spent, and then your entire economy can reset. But some believe that that money is still out there and still not spent yet, which is why we still have overspending and we have too much demand in our economy, thus the high interest rates. And also there's other issues still, like economic lockdowns in China and geopolitical problems and wars like Russia and Ukraine. So those are all causing problems too that are keeping prices really, really high. At the end of the day, there is really nothing the Federal Reserve can do here, because they don't have full control over every aspect of our economy. They can't control what China does with their economy. They can't control what private businesses do with their production and their wages. They can't control all of that money that's already been out there. The only thing that they control is their interest rate policies. And what you're probably thinking is, well, what if they just lower their interest rates, right? That would mean that we would stay out of a recession, everything would boom once again. And you're right, everything would boom once again. We would have businesses investing like crazy, the stock market would explode, consumers would be getting all of this money, and that would feel pretty sweet for a short period of time before inflation goes right back up and prices have to rise once again too. So that's not really a solution either. So no matter what the Federal Reserve does here, they're basically screwed. I can't tell you what the Federal Reserve is going to do with its monetary policies. Nobody has a magic ball that can tell you exactly what is going to happen next in 2023. The only thing that I can tell you is now this is the time that you need to be prepared with your finances and try to learn everything you can through financial education. Just like the Fed doesn't have control over a lot of our economic factors, you don't have control over what the Federal Reserve does. So you should spend less time worrying about what they're going to do and more time actually preparing your finances in case something goes south. That means creating a budget for yourself and having savings set aside and continuing to invest no matter what, because that beats inflation. And there really isn't no hurt to it either, because even if we don't see a lot of big problems in our economy this year or next year, then now you're prepared and you have all of this extra money sitting around, so you can do whatever you want with it. Versus if you didn't have that money and we did see a problem, well, now you're screwed too. You kind of control your own destiny here, and I want you to succeed no matter what happens, but that kind of starts with you taking responsibility for your financial future. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.